There is a number that the Canadian real estate industry does not want you to focus on, and that number is 1,599. That is the total number of new condo units sold across the entire Greater Toronto Area in all of 2025, the full year, every single month, in what was once called the hottest condo market in North America. According to data published by the research firm Urbanation, that figure represents a 60% collapse from the year before and the lowest annual sales total recorded since 1991, the year of the last major housing crash in this country. And here we are in mid-2026, and instead of a recovery, the first quarter of this year just came in at 246 new condo sales, which is down 52% from the same quarter a year earlier and a staggering 94% below the 10-year average for the period. That is not a soft market or a correction or a normalization. That is a market that has functionally stopped working, and the people being destroyed by it are not hedge funds or foreign speculators, they are Canadian families who were sold a dream and are now sitting on a financial time bomb. The condo market in Toronto and Vancouver was not built on end-user demand, and it was never really designed to be. John Pasales, president of Realosophy Realty, whose research has been cited by the Bank of Canada and the International Monetary Fund, wrote bluntly in early 2026 that these units were not primarily built for people who wanted to live in them. They were built for investors expecting rising prices, low borrowing costs, and easy returns, and that model stops working the moment rates rise and prices fall. And that is exactly what happened. Investor demand disappeared, the pre-construction financing system seized up, and the towers stopped getting built. Pasales has argued repeatedly that Toronto's obsession with investor-funded housing supply made the boom more extreme on the way up and made the crash more severe on the way down, and the data confirms that analysis completely. According to the Toronto Regional Real Estate Board's official Q1 2026 condo market report, the average selling price for a condo apartment across the GTA fell 9.1% year-over-year to $618,484, down from $680,243 in the first quarter of 2025. Inside the city of Toronto specifically, the average was $649,330 versus $711,258 a year earlier, meaning Toronto condo owners lost roughly $62,000 in average value in a single year. The Maple Metric, a Canadian housing data newsletter, reported that the average GTA condo peaked at nearly $800,000 in early 2022, meaning the total decline from peak to today is approximately $180,000, and most analysts are not calling the bottom yet. But if you think the price numbers are bad, wait until you understand what is happening to the investors who bought these things, because the cash flow math is the story that explains everything. CIBC Deputy Chief Economist Benjamin Tal, writing jointly with Urbanation President Sean Hildebrand, published research showing that 81% of investors who took out a mortgage to buy a newly completed condo were cash flow negative, losing an average of $605 per month. That figure, reported by the Globe and Mail, was up from 77% of investors losing $597 per month the year before, and up from just over half of leveraged investors in 2022. Let that trajectory sink in. In 2020 and 2021, most condo investors in Toronto were actually cash flow positive, meaning the rent covered the mortgage and then some. By 2026, more than 4 out of 5 are bleeding money every single month, and the average monthly loss is over $600. For investors who own 2 or 3 units, which is not uncommon in this market, that is a $1,200 to $1,800 monthly cash drain on top of their regular living expenses, and that is before you factor in special assessments, rising maintenance fees, and vacancy months. The math is not complicated, but it is brutal. Take a $650,000 condo in the GTA, which is roughly in line with current average prices. Put 20% down, and you are financing $520,000. At a 5-year fixed rate of around 3.69%, according to January 2026 mortgage market data, your monthly principal and interest payment is approximately $2,680. Add average condo maintenance fees in Toronto of roughly $600 to $700 per month, property taxes of around $300 per month, and landlord insurance, and you are looking at total carrying costs of approximately $3,700 to $3,800 per month. Now try to rent that unit. According to data cited by multiple Canadian real estate analysts, average one-bedroom rents in Toronto fell to $1,993 per month as of early 2026, with two-bedroom units averaging around $2,600. The monthly shortfall on a one-bedroom is around $1,700 to $1,800. The shortfall on a two-bedroom is over $1,100. That is the negative cash flow trap. The investor is not building equity, they are subsidizing someone else's rent while slowly being eaten alive by carrying costs, and the appreciation that was supposed to save them is pointing in the wrong direction. A team at Elevate Realty, a Toronto investment brokerage, published analysis in mid-2026 stating that for a Toronto condo to simply break even on monthly cash flow, prices would need to fall another 40% from current levels, taking them back to roughly 2015 valuations. And even then, they wrote, they still would not recommend buying one. This is why the investor exodus is not just a market story, it is a structural demolition of the supply pipeline. Developers need roughly 70% of units pre-sold before a bank will release construction financing. When investors funded the market, that threshold was routinely hit within weeks of a project launching. In Q1 2026, according to Urbanation data cited by the Maple metric, no new condo projects launched at all in the GTA. 0. And that gap is going to cause a very different kind of crisis in 3 to 4 years, but we will get to that. The situation in Metro Vancouver is running on a parallel track, with its own equally grim set of numbers. According to the Greater Vancouver Realtors February 2026 monthly report, analyzed in depth by Rain City Properties founder Grade N. Douglas, Metro Vancouver recorded 1,648 home sales in February of this year, which was down 9.8% from February 2025 and sat a full 28.7% below the 10-year seasonal average of 2,310 sales for that month. The GVR's own chief economist Andrew Lee said in the official release that the pace of sales running well below long-term averages is no longer a surprise, and that it has become the new norm. That is a remarkable thing for a board economist to say publicly, and it tells you that the institution responsible for selling the Vancouver dream has essentially stopped pretending a quick rebound is coming. The condo segment was the weakest link in Vancouver too, with apartment sales falling 15.6% year-over-year while townhouse sales actually increased 7.8%, a split that reflects the same forces at work in Toronto, which is an oversupply of condos pushing buyers toward attached low-rise alternatives where the strata fees are lower and the value proposition is stronger. Active listings across Metro Vancouver sat at 13,545 homes, which is 6.3% higher than a year ago and 37% above the 10-year seasonal average of roughly 9,900 listings. To translate that into human terms, there are approximately 3,600 more homes for sale right now than you would normally expect to see at this time of year, which is the equivalent of an entire mid-sized neighborhood sitting unsold on the market as surplus. The benchmark price for a condo apartment in Metro Vancouver was $708,200 in February 2026, down 6.8% year-over-year, according to the GVR statistics table. The metric that tells you most about where prices are heading is called the sales to active listings ratio, and the Vancouver numbers are worth understanding carefully because they explain the mechanics of how a buyer's market creates sustained price pressure. The overall ratio for Metro Vancouver in February 2026 was 12.6%, right at the threshold below which prices tend to decline. But broken down by property type, detached homes sat at 9.0%, 0%, which is firmly in buyer's market territory, while condo apartments came in at 14.1%, which is technically balanced but drifting lower as new pre-sale supply continues to land. The rule of thumb used by most industry analysts is simple: below 12%, sellers are losing leverage and prices fall; above 20%, sellers have the advantage and prices rise; and in between, it is a negotiating war where every individual property is its own battle. Vancouver's condo market is sitting at the edge of that cliff, and the trend line is pointing down. Now here is where the story gets genuinely alarming, and it is the piece of the puzzle that most of the headlines are missing entirely. The crash happening right now in 2026 is not just destroying current investors and current owners. It is simultaneously constructing a shortage that will crush renters and first-time buyers starting around 2028 or 2029, and there is almost nothing that can be done to stop it at this point. The Bank of Canada published an analysis in February 2026, titled "What is Behind the Slowdown in Toronto's Condo Market?", which noted that builders are struggling to sell existing and planned units amid an exodus of short-term investors from the market and a mismatch between supply and demand, and that the slowdown is the latest in a series of challenges facing the largest housing market in the country. The numbers behind that statement are striking. Full-year condo completions in the GTA are projected to fall to 21,850 units in 2026, down from nearly 30,000 in each of the previous 2 years, with further declines expected through 2028. John Pasales wrote on his platform that by 2029, Toronto could have virtually no new condos completing at all, a projection sourced directly from Urbanation supply pipeline modeling. Meanwhile, developers who do have standing inventory are refusing to drop prices to match the resale market. According to data cited by the Maple Metric, resale condo units were averaging $859 per square foot in Q1 2026, a 25% decline from the peak, while developers are still asking an average of $1,189 per square foot for new standing inventory, a 38% premium over comparable resale units. And that gap, that absurd 38% spread between what the market will pay and what developers need to charge to cover their locked-in costs, is precisely why no new projects are launching, because no rational buyer will pay that premium when an identical resale unit exists for 28% less. Benjamin Tal of CIBC described this dynamic in his widely cited analysis as the market being frozen, and his exact language is worth repeating because it captures the trap perfectly. He said the housing market is too expensive to buy and not expensive enough to build, meaning buyers cannot justify the price and builders cannot justify the risk, and those two forces are pinning the market in place while the supply pipeline quietly runs dry. Tal also warned, writing jointly with Urbanation's Sean Hildebrand, that condo prices in Ontario had already fallen about 22% from peak and could slide another 10 to 15% before the market clears, with construction activity at basically zero in the new launch segment. The pre-construction trap being sprung on buyers right now deserves specific attention because it is one of the most financially devastating things happening to regular Canadians, and it is almost entirely invisible in mainstream media coverage. According to Urbanation data and CMHC research, an estimated 28,000 condo units are completing across the GTA in 2026, the biggest wave in the entire correction cycle, and a widening number of those buyers are arriving at their closing date to discover that the unit they agreed to buy years ago at peak prices is now worth significantly less than their purchase contract requires them to pay. Consider the scenario described by the Maple Metric. An investor put down a $200,000 deposit on a pre-sale unit valued at $1 million in 2022. Today, the market price of that unit has dropped to roughly $700,000. But the contract still says $1 million. The builder is not renegotiating. The investor either closes at a $300,000 loss or walks away and gets sued. Approximately 3,000 units, or about 10% of pre-sold condos that registered in 2025, were taken back by developers after buyers failed to close, not because those buyers changed their minds, but because their lenders appraised the property below the purchase price and refused to fund the full mortgage. These are not speculators playing games. These are people who had appraisals come back short and literally could not find the extra cash to close the gap. John Pasales put the structural failure of this system plainly in a piece he published on Move Smartly earlier this year, writing that real recovery will not come from a rate cut or a policy tweak, but will come when housing prices realign with what local incomes can actually support, and when homes once again look like places to live rather than vehicles for speculation. That single sentence is the entire thesis of what is happening. For roughly a decade, Canada's housing policy, particularly in Ontario and British Columbia, effectively treated investor demand as a substitute for genuine affordability planning, and the condo market was the most extreme expression of that substitution. When the investor demand evaporated, the illusion evaporated with it, and what is left is a market where prices are still too high for most families but too low for most builders, a gap that no single policy lever can close quickly. Now let's look at exactly which neighborhoods and submarkets are getting hit the hardest, because the word Toronto and the word Vancouver are doing enormous work to hide the specific geography of where this correction is most severe. In the GTA, the pain is concentrated in high-density condo nodes that attracted the most investor activity during the boom years. The downtown Toronto core, particularly the blocks immediately east and west of Yonge Street between Bloor and the waterfront, has the highest concentration of investor-held units completing in 2026 and the most active listings per capita in the condo segment. The North York corridor along the Yonge and Sheppard subway lines, including the towers around Mel Last Man Square, saw explosive pre-construction activity between 2018 and 2022 and is now facing a wave of completions into a rental market where rents have been falling. Mississauga City Centre, around the Square One area, built its entire identity on condo density and saw some of the sharpest price increases in the GTA during the pandemic run-up, making it equally exposed to the current reversal. Vaughan, Markham, and Scarborough all saw significant pre-construction investor activity and are now dealing with elevated active listings and extended days on market for condo units that simply do not have the end-user buyer pool to absorb them at anywhere near peak pricing. In Metro Vancouver, the picture is similarly geographically concentrated. The Cole Harbour and Yaletown neighbourhoods in downtown Vancouver have among the highest condo ownership ratios in the city and among the most investor-held units on a percentage basis, making them sensitive to any shift in investor sentiment. Burnaby, particularly the Metrotown area and the Brentwood neighbourhood, saw massive condo tower construction during the 2017 to 2022 cycle and is now facing inventory build-up as those completions hit a market where absorption rates are well below the 10-year average. Surrey and Langley in the Fraser Valley attracted significant pre-construction investor activity due to lower entry prices, and with the sales-to-active ratio for detached homes across Metro Vancouver sitting at just 9%, the pressure is extending into the suburban condo markets as well. Richmond, with its historically high investor ownership rate particularly among the speculative buyer segment, is seeing extended listing times and price reductions on condo resales that would have been unthinkable 2 years ago. Here are the 3 scenarios for where this goes from here, based on the data available in mid-2026. The first is the best-case scenario, and let's be clear that the conditions required to produce this outcome are not currently in place. In the best case, the Bank of Canada delivers 1 or 2 additional rate cuts in the second half of 2026, bringing the overnight rate below 2% and pushing 5-year fixed mortgage rates toward the low 3% range. This, combined with the tightening of new listing supply that TREB data from April 2026 is beginning to hint at, would stabilize condo prices in the resale market and start to reduce the inventory overhang. New presale activity would cautiously restart in late 2026 or early 2027 as developers repriced projects closer to the market. Some of the pre-construction appraisal gap problem would be resolved through developer concessions, and the negative cash flow situation for investors would ease enough to bring some marginal buyers back. In this scenario, prices bottom sometime in late 2026, spend 12 to 18 months flat, and begin a slow recovery from 2028 onward. The reason this outcome is unlikely is that it requires a convergence of multiple positive forces simultaneously, the that rates fall further than the current Bank of Canada guidance suggests, that the trade uncertainty driven by the U.S. relationship lifts meaningfully, that immigration rebounds to support rental demand, and that developers decide to stomach losses to restart the pipeline. CIBC's Benjamin Tal himself, one of the most optimistic mainstream voices on Canadian housing, described 2026 as a transition year with the first half remaining weak and a more meaningful improvement only expected in the second half as conditions clear. The second scenario is the realistic case, and this is where the majority of analysts who follow this market closely are landing. In this scenario, condo prices in the GTA and Metro Vancouver decline an additional 5 to 10% through the remainder of 2026 and into 2027, consistent with Tal's forecast of another 10 to 15% from peak before the market clears. The investor exodus continues and the pre-construction market remains essentially non-functional through 2027, with sporadic launches that fail to reach their pre-sale thresholds. The rental market stays soft as investor owners list their units for rent rather than selling at a loss, keeping downward pressure on rents and further degrading the investment case for buying new condos. The Bank of Canada either holds rates steady or is forced to raise them to address inflation driven by tariff-induced cost increases, which is a scenario Avery Schoenfeld at CIBC has flagged as a tail risk even if he does not view it as the base case. In this environment, the wave of mortgage renewals hitting Canadian households, many of whom locked in at sub-2% rates during the pandemic and are now renewing at 3.5% to 4%, creates a consumer spending shock that further suppresses demand. Condo prices in the GTA fall an additional 15 to 20% from current levels, which would represent a total peak-to-trough decline of roughly 35 to 40% in nominal terms. Developers begin returning land to lenders through insolvency proceedings, the number of power of sale listings in the condo segment spikes visibly, and the construction pipeline for 2028 and 2029 comes in so empty that the shortage arriving at the end of the decade is severe enough to trigger the next price surge, repeating the cycle all over again. Now let's talk about what this actually means for you, specifically, based on where you sit in this market. If you are a renter in Toronto or Vancouver right now, the data from mid-2026 is almost entirely in your favor in the short term. Average Toronto one-bedroom rents are around $1,993 per month, down from over $2,300 at the peak, and the rental market has softened because distressed condo owners are listing their units for rent rather than selling at a loss, which has added supply to the rental pool. You have genuine negotiating power on lease renewals and on signing a new unit, and you should use it. The catch is that this situation almost certainly reverses sometime between 2028 and 2030 when the construction pipeline runs completely dry and the supply shortage hits. If you are planning to stay in one of these cities for 5 or more years and have the down payment and income to qualify for a mortgage, the argument for buying a condo at current discounted prices and holding it long-term is stronger than it has been at any point since 2019. If your timeline is shorter, renting and investing the difference is mathematically the better play right now. If you are a homeowner or condo owner facing a mortgage renewal in the next 12 to 18 months, the key number to understand is what your payment looks like at current rates versus your original rate, and whether your household cash flow can absorb the difference without forcing a sale. Rates today, around 3.69% for a 5-year fixed, are meaningfully higher than the sub-2% rates many buyers locked in during 2020 and 2021, but they are significantly lower than the 6% plus rates that were prevailing in late 2023. The majority of people renewing right now will see payment increases but not catastrophic ones, and the Bank of Canada's rate pause suggests the environment is not going to get dramatically worse in the near term. The danger zone is a small number of households that are already stretched on cash flow from a negative cash flow investment property plus a primary residence mortgage renewal happening simultaneously, and if you are in that situation you need to run the numbers honestly and not assume a market recovery will arrive in time to save you. If you bought a pre-construction condo in 2021 or 2022 and are closing in 2026, this is the most urgent message in this entire analysis. Get an independent appraisal before your closing date. Do not assume your lender will fund the full purchase price from your original contract. If your appraisal comes in below the contract price, you will be required to cover the gap in cash at closing, and developers are not voluntarily renegotiating. Talk to a real estate lawyer who has specific experience with pre-construction closings in this market before your closing date arrives, not the day before, and not the day of. If you are an investor currently holding a condo with negative cash flow, the honest answer from the data is that a meaningful recovery in your investment returns is a 2028 story at the earliest, and quite possibly a 2029 or 2030 story. The investors who survive this cycle, according to analysts at DDID who track Toronto condo investment conditions closely, are those with low leverage, long-time horizons, and the ability to absorb short-term losses without being forced into a sale. If you cannot honestly say that describes your situation, the math of holding a depreciating asset with a $600 per month cash bleed is a question you need to answer with a spreadsheet, not with optimism. Selling at today's prices and redeploying capital into an asset with positive cash flow is not admitting defeat. It is recognizing that the condo thesis that 10% annual appreciation would cover monthly losses has stopped working, and waiting for it to come back while losing real money every month is a financial choice, not a strategy. If you are an investor looking at Ontario or British Columbia and wondering whether this is a buying opportunity, the honest answer is that it depends entirely on your time horizon. The next 12 to 24 months are almost certainly going to involve additional price erosion and a continued soft rental market, so buying to flip or buying to hold short-term is not supported by the current data. Buying well-located units at prices close to or below 2015 valuations with a minimum 5-year hold in mind, and with the financial reserves to survive negative cash flow through the bottom of the cycle, is a fundamentally different and potentially defensible thesis, and it is the thesis that large institutional investors are beginning to act on. A $500 million commitment from a single investment firm to acquire over 1,000 Toronto condos was reported in recent weeks, with the explicit thesis that today's oversupply will become tomorrow's shortage. The question is whether individual investors have the same depth of pockets and the same tolerance for near-term losses as institutional capital. Thank you for watching this full breakdown, and remember that every single statistic and report mentioned in this video is linked down in the description below so you can verify the numbers yourself. If you are dealing with this in your own life, or if you completely disagree with my analysis, please let me know in the comments because I read them all. Make sure to subscribe for more deep dives into the economy and real estate market, and I will see you in the next one.